Hi, everyone. This is Josh Nelson and Lucas Casarez from Keystone Financial Services. We're going to get started here in just a few minutes, but before we get started, I want to make sure that everybody can hear us. So it looks like we've just got a few attendees that are signed in. As we get other people signed in, we'll repeat some of this information. But for the people who are on right now, could you do me a favor and in the questions box, just type either a yes or no if you can hear me. Of course, if you can't hear me, you probably won't type anything. But if you would type a yes in the questions box, that would be great. So not seeing anything yet. Can you hear me? Under the questions, if you could type in yes, that way I can tell that everybody can hear us. All right, not seeing anything yet. So as we get a few more people signed in here, I'll keep watching for it. It shows that I have sound going through on my end, but I want to make sure that everybody can hear. If you've got the questions box in front of you, if you would type in yes, please, or yes, I can hear you, or something else, that'd be great. All right, looks like we've got 5 people attending so far. That's great. It'd be really cool. It actually shows that under webinar we have 101 maximum that we can get. That's my dream, is that one of these days we're going to get maxed out and we're going to have to, yeah, there we go. We've got a few questions. Everybody says they can hear. Good. Yeah, one of these days, though, that'll be fun. We'll get 101 people that sign up and we'll have to upgrade to the next version of GoToWebinar. So it looks like everybody can hear us. We're going to get started right at the top of the hour here. I know your time is valuable and you're taking time out probably over your lunch hour, so thank you for giving us that. We don't take it lightly that you put a lot of your trust in us for years and years. I started back in 2001 back at what was HP Federal Credit Union at the time. Actually, I think it was called HP Employees Federal Credit Union at the time. And right off the bat, that was one of the things that I enjoyed the most, was doing financial education. And we used to do it on the HP sites, but now we do it at other locations. And of course, we're using webinar format. So it looks like we've got 6 people. I see Ron signed in. Thank you. And when my clock strikes 12, we'll start with the actual educational portion of today. All right, it's 12 o'clock. We'll get started. We are recording this, so I share that with you just because we will have the opportunity for you to be able to send this out to a coworker or to a friend. Hopefully you can see me right now. That would be great if you could share that with other people afterwards, because there's probably going to be some things that pop up that you say, oh gosh, I wish my spouse or my friend, my coworker would have heard this. And we always want to be able to provide that after the fact so you can share that with them. Again, my name is Josh Nelson. Keystone Financial Services is the firm here in Loveland, Colorado. Today we're talking about markets and the economy, and we always do a market forecast in January, and we do a halftime event usually in the July-August timeframe to talk about where the year is so far and where we might end up for the rest of the year. So that's probably the number one thing that comes up when I tell people I'm a financial advisor, or when a client comes into the office. They want to talk about, gosh, things are so volatile right now. I see all these crazy headlines. So this is really relevant information, because it seems like every day a crazy headline does come out, whether it's about North Korea or somebody's crazy Twitter feed or something like that. It's pretty interesting to see the fact that the market really hasn't reacted much to it yet. But in a normal market environment, we do see volatility for some of the very things that are hitting headlines today. So today we're going to go through and talk about the markets and the economy. the relevant information today is the fact that things are actually doing pretty well, and we feel good about the economy. But that doesn't mean that there aren't some dark clouds out there that could become thunderstorms or tornadoes or hurricanes, whatever metaphor you want to use. But we are very, very diligent at watching the market and the economic numbers to be able to at least understand what's going on. And again, our goal today is to educate you. So with that, we're going to jump on and start the actual content today. The one thing that we'll start with here is that we will be talking about three things. As always, we're going to talk about where we've been, where we are, and where we might be going in the future. This is what the attorneys wrote. Hopefully everybody can read that real quick. All right, and again, where we've been, where we are, where we may be going. But before we do that, we're going to warm up our brains, hopefully shift gears a little bit if you've been in engineering mode or teaching mode or medical mode or whatever career path that you're on right now. We'll warm up our brains. There's graphs like this that come out all the time in different financial publications, but we put a few ones out here that would be kind of fun today. So you might not know that this is actually a map of some data, and data can be interpreted different ways, and sometimes the same data can be interpreted completely different ways based on the economist or the president or whoever it is that's looking at the numbers or trying to share that with you. So this one actually was the states and what predominantly company is associated with that state. For example, Colorado, you've got Chipotle. Actually, Qdoba, I think, originated in Colorado as well. Of course, California, in and out. So kind of interesting to look at what companies are associated with each individual state. The next one here is kind of interesting because we have some hard data on something that's kind of hard to measure, and that's that the UFOs are pretty friendly, and they actually tend to visit during drinking hours and during the hours of the night. Interestingly enough, they also tend to visit more in the northern states. I don't know if that's the Northern Lights or what that might be, but yeah, kind of interesting that the UFOs are friendly enough to come when people have been drinking more often. This one here is kind of interesting because what it overlays is it looks at the countries and what their GDP is compared to the individual states that we've got. So that's one testament to how strong our country is and what an economic powerhouse we are compared to the rest of the world. Now, I don't know if it's a good thing or not, but my home state of Iowa there shows that Greece is the roughly equivalent GDP of the state of Iowa. And here in Colorado, we've got Egypt, California, France. We've got clients that are all over the country, and it's kind of interesting to see how strong your economy might be in your individual state. And then finally, purchasing power here. What this shows us is it shows us in each individual state how far $100 goes. So the interesting thing here is that in the state of Colorado, $100 only buys $98.04 worth of stuff. Versus you look at some other states, again like Iowa, $1.10, so you could live a lot more richly if you had the same amount of money. In Iowa, it would just buy a lot more stuff. The most expensive states, as you might imagine, are California and some of the East Coast states. But again, Colorado actually is one of the most expensive states right now, evidenced by our very, very low unemployment rate and our very tight housing market that we've got right now. Pretty interesting that economic prosperity sometimes will not necessarily translate into purchasing power. Sometimes it takes a lot more money to be able to make it. So with that, we're going to go about where we've been, reviewing some of the information so far this year. And, there's a lot of things that we don't know. And I think just being frank about that, economists really don't know. I don't care who it is, even the Fed chairman really doesn't know what's going to happen. It's all educated guesses, and sometimes the data can lead you the wrong way. So where we've been, really, the story, it seems like over the past year has been all about politics. And certainly Donald Trump and his various tweets and so forth, he's very, very good at commanding headlines, whether you like him or not. But you've got a wide variety of opinions on individuals as far as where they think the economy is going. And of course, this can oftentimes be based off of if your party got elected or not, but as a not real surprising right now, Republicans are very optimistic about the economy, Democrats are not, although independent voters tend to be fairly optimistic right now as well. But then you look at just the opposite. When Obama was elected, of course, Republicans said that that was the end of the world. Independents did too, and Democrats were really optimistic. But one thing to keep in mind, whether you're happy right now or not so happy about the political environment, is that there's very little correlation. In fact, I would say no correlation to what political parties in power and what the market or the economy are doing. For example, you can look under Ronald Reagan, you had a Republican in office, and the economy in general did very, very well. The market did very well. But then you had Clinton in power for most of the 90s, and the market also did really, really well. On the same token, you can look at the same thing with opposite parties and find that the market can do really poorly under each as well. So we've been talking about in the past about a plow horse economy. The economy continues just to trudge forward, not very quickly, but we are still moving forward. I don't know if we're ever going to get to, I know some political pundits say that there's this goal of 3 to 4% GDP growth. I'm not sure that we're going to get to that anytime in the near future, but yeah, the economy still continues to grow. That's the important part, is we're not in a recession and not anywhere close to it at this point. The markets, as you probably are not too surprised, the markets in general have been moving upwards. The indices that you see here are global markets, so you see the UK, the US. Most markets are positive right now, and more recently international markets have been doing better than US markets. We're starting to see that breakout over this past year. Corporate profits have been the primary driver. Corporate earnings ultimately are going to be why a stock is priced at a certain level, and that's whether it's a really small company or a really big company. At the end of the day, it's going to come down to what's the profitability of that company. So you can see earnings growth of the S&P 500, generally good. You can see what's negative there primarily has been energy. Energy sector has been depressed for some time, but the rest of the economy generally has done well, and earnings have shown that in corporate profits. The other thing that's been helping is that central banks continue to keep rates low. In Europe, we talked about the fact that we actually had negative rates for quite some time. And in the US, we're just starting to see rates tick up a little bit. The Fed is very, very slowly raising our interest rate. And the primary reason why you're seeing that is that whether it's the Fed or the European Central Bank, any central bank is going to be concerned about raising interest rates and stunting any type of economic growth or throwing the economy into a recession. So that's the thing, is that the Fed is being very, very cautious right now. They are raising rates back to more normal levels. We're still historically at very, very low rates, which I'm sure you're all very happy about right now. If you are trying to refinance a mortgage, buy a home, interest rates are very, very low, and it's going to take some time to get back to more normal levels. In general, that's one of the things that helps, is rates being low tends to spur economic growth. So now I'm going to pass it over to Lucas Casarez. We're going to talk about where we are now.
Hello, everyone. Thanks for joining Josh and I today. We definitely appreciate you guys taking the time out of the day to join us. And obviously, it didn't work out to where you're able to make the physical event, but I think through some of the charts that we go through, it's actually a lot easier for you guys to see these things. So I think there's some benefits to it as well. Looking at this cartoon that we have here, where we are right now is both economic experts as well as individual investors are both bullish and skittish all at the same time. And I always enjoy the comics that we end up getting pulled into these forecast and halftime report events, because I just find them super entertaining. Looking at this one here, they're taking a look at what they think is a monster looking thing, and they're definitely ready to bolt and run for the door. Then they realize, well, it's not actually a bear market, and so they're going to stay bullish. And even with slow growth not being the best thing for investments, it's still better than negative growth, which is what we were looking at in the previous economic recession. So people are still pretty optimistic when you compare it back to how things looked in 2008 and 2009. So looking at how the markets have performed year to date as of June 30th, definitely Josh had hinted at it that emerging markets, international markets have finally broke out from their kind of breaking even and even losing value over the previous couple of years. And so it has paid off more recently this year than it has in the last handful of years to be more diversified in your portfolios because you're able to recognize some of that growth internationally, even though the U.S. has not been too shabby itself. Digging in a little bit deeper into the emerging stock markets result, you can see that China and India were going to be the heavy pullers of those indexes, and Russia has been consistently over the last 2.5 years falling short and losing value in terms of their stock market. And Russia's been hit pretty heavily with the reduction of oil costs, and production has slowed dramatically, which is a big economic factor for their country specifically. And going back to one of the slides that Josh was looking at in regards to interest rates, they're also one of the highest interest rates. I think they were moving from 10% in Q4 2016 to 9.75%. So they are trying to spur that growth and get things moving along. But they have extremely high interest rates right now, which impacts borrowing and potential business reinvestments. Looking at the United States a little bit more specifically here, this is showing us the average price to earnings ratio of companies in the S&P 500, and you can tell that right now things have been going above the trend lines, both of the 5-year average trailing PE ratio and the 10-year. That doesn't necessarily mean that there's not opportunity for growth down the line, but what it does mean is that we definitely have to be paying a little bit closer attention. Things have been unusually smooth the last 1.5 years, and so one thing that I'm sure Josh is going to echo on for the later half of the presentation is things are going to get a little bit more choppier. They almost have to with how smooth things have been. Some of the things that could cause a dent in consumer optimism and investor optimism is going to be how quickly those interest rates rise and whether that has a negative impact on borrowing for businesses and economic growth. So those are going to be some of the things that Josh will talk about here in a little bit. Focusing even deeper on that S&P 500 is the performance. You can see, and I'll help draw this out. This is one of the benefits of joining us via webinar rather than being at the physical event, where it's much harder to see these different bar graphs. The S&P 500, you can see, has been at about 8.2%, so right in this range of the graph. And the interesting thing is that information technology has been leading the charge for the S&P 500. Actually has contributed to about 40% of its performance, even though it's just a portion of the overall value of the S&P 500. So the information technology, especially for everyone joining us today, definitely relates to your background being in the engineers and tech industry. And you could probably guess off the top of your head what those companies are that are leading the force. It's going to be Facebook, Google, Amazon, and Netflix are going to be the main factors, but there have been a lot of other tech companies that have been pushing that bar as well, so that's important to know. A really interesting thing that has occurred over the last few years is that value stocks have, for the first time in a long stretch of period, underperformed growth-oriented stocks. And so that's something that hasn't been seen in the last 100 years, 50 years, and 20 years. And I'm sure Warren Buffett's not too happy with how that's produced right now, but at the same time, he's doing just fine with his method. It's not that they're not growing at all, it's just they haven't been growing as quickly or as strongly as history would have indicated. We feel that definitely, just like any trends, those things are going to come to their normal averages, but that doesn't necessarily mean that it has to happen quickly, so that may not be a quick turnaround time to draw those numbers closer together. Josh mentioned it a little bit with the various geopolitical events that have been going on, and ironically, it has not been spurring too much volatility, too much jitterness in the stock market. It seems like as things come out, the stock market just keeps clicking away. There's been a few occasions over the last year, if you think back to Brexit, which happened just over a year ago, there was a significant drop over a 2-day period, and then it quickly recovered. That has really been the last time that we've seen any significant volatility. And it's not to say that we had a shortage of those types of shocks. Want to keep things pretty positive. Obviously, there's a lot of negative things going on in the world, but there's also always positive things to draw back on. And I think that's what's been reinforcing the values and the growth of the current stock market, is that there's a plenty of things to look at and focus on that are definitely positive matters. And with that, I will pass it back to Josh for where we are headed.
All right, thanks, Luke. Yeah, volatility is so low. In fact, it's about historically about half of the historical average right now. So things are eerily calm. And the last time we saw a market correction actually was about, gosh, close to 18 months ago now. We're getting to that point where on average the market corrects about once a year, so 18 months without any kind of a correction or really any kind of significant volatility. That's why I'm more concerned than anything, not because I see any bad economic data or because there's a lot of bad earnings reports or because inflation is out of control. Actually, all those things are looking good right now, but it's still, the market is the market, and it is volatile. That's the nature of it, and it tends to react to some of these things. So obviously we can't predict the future. We can't predict what's going to happen with all these different things geopolitically, but we can certainly anticipate it and look out for opportunities when we're balancing portfolios. So, depending on what economy you're looking at, they're in various stages, and you could probably debate this. By the way, we've actually got ourselves in an expansion, would be where you'd put the U.S. right now, and maybe some others are coming up the peak, and some others are starting to dry up, like the UK. But overall, you look into the mid to late, that's pretty indicative of where we are right now, is that profits are good, credit's good, growth is peaking. Credit, by the way, I mean debt, actually, meaning that you can get a loan, that companies can get loans easily, consumers can get loans easily. Obviously, as we saw back in 2006, 2007, credit can get too easy at some point and can cause problems. That was what caused our financial crisis. So we're probably getting towards the mid to maybe even late, depending on what economist you're talking to, stages of our economic growth. And again, we continue to plow along. Earnings growth still very good. Energy, you can see there's this huge spike on the right-hand side there. That's mainly just because energy profits have been so poor before. That's why you see this big spike now. It's not because energy stocks are that great, and who knows, maybe they will be, but that's not a call for you to go out and buy a bunch of energy stocks right now. Stay diversified as always. One thing to kind of pause on now too is I will certainly open it up for questions at the end. Luke and I are sitting here and we'll answer any economic questions, the market questions, financial planning questions. We won't answer any political questions, but we'll do our best to answer any questions that you've got. So feel free to start adding those in the queue, in the questions queue right now, and we'll touch on those towards the end of the presentation. Now you can see a lot of different experts. That's one of the things we have fun with in these presentations, is that we pull some opinions from experts, and the bottom line is that the experts are not always right, and they really don't know either. Again, it doesn't matter who it is or how much information they've got. They still can't predict the future because the world is just too complicated. There's too many unpredictable things that are out there that will impact the markets and the economy. And oftentimes the things that cause a market correction or a financial crisis even are not something that anybody could have predicted. So you can see this quote here. This is from Russell. So our global team of investment strategists warned that investor expectations have run ahead of market fundamentals in the global equity markets. They maintain a call for caution as inflated expectations for global growth and U.S. fiscal policy drive markets higher despite looming global economic headwinds. in the medium term, they are not bearish. I don't even know what this means, frankly, and I've been doing this a long time. Basically, I think this is just their way of not really giving an opinion and hedging their bets. So one thing to be cautious on is that clearly this is an honest outlook in that they're saying that we don't know. Essentially, they don't know what's going to happen, and they had to write something. So just a caution that whenever you're listening to an expert, make sure that you put a filter on that, because recognize that they don't know either, but they're being paid to give an opinion. And then Schwab's market perspective here, I thought actually was pretty interesting. They give a few things to be happy about. Again, low interest rates, good earnings, strong labor market. Gosh, in Colorado now they say we're less than 3% unemployment, which is just crazy. That means that, at least statistically, anybody who wants a job has one if you're here in this state, and the national unemployment rate is very low right now. In fact, I think it could even be a problem at some point. It could cause an inflation problem simply because wages have to go up dramatically to keep up with demand for labor. But in any case, if you were to look at bears, you can see our picture of bears. The three things out there that would result in a bear market, we think, would be one of three things. One of those would be an economic slowdown, and that's not likely right now. It would require a big shock event, I think, to cause that, because the economic fundamentals are just really strong right now globally. The second two, a lot more likely. This is more the headline risk that tends to really shock markets, and of course we could all brainstorm and think of things that have happened like 9/11 or Bear Stearns going bankrupt and Lehman Brothers, all the other financial companies that either were forced into bankruptcy or were forced into marriage to another company, essentially. But those events can cause the market to drop and drop really sharply. And then thirdly, a geopolitical blow-up. Certainly North Korea and other countries have been in the news too, but North Korea was the one that probably has been in the news the most here recently. That's quieted down, at least the last few days from what I've seen. But bottom line is that geopolitical blow-up, whether it be in the Middle East or Venezuela, North Korea, conflict, maybe even economic conflict between us and another country, certainly could cause the markets to be volatile. If you think of the worst market pullback we've seen in recent times, it was actually in 2011, which, believe it or not, most people don't even remember it now. But that was when, remember the pigs? We talked about the pigs. That would be Portugal, Ireland, Italy, Greece, Spain. We talked about those countries back then as all being, some were predicting we're on the verge of insolvency, of bankruptcy. They would end up defaulting on all their bonds, and it would cause all the European banks to be insolvent and go broke and wreck the European economy. That's what was being talked about back in summer of 2011, and we saw a very sharp 20% pullback in the market at that time. The good news is we recovered all of that value by the end of the year, but I throw that out there for two reasons. Number one, that wasn't necessarily a predicted pullback, and second of all, market recovered fairly quickly. So just because we do see a sharp decline, it could be one of these unpredictable things, but that doesn't mean that the market's going to stay down or it's going to cause some kind of a permanent disruption in the global economy. So the four things to look at right now, the four things that we're looking at primarily as far as risk, or maybe even opportunity if they go well, but looking at political risk, again, there's a lot of stuff happening around the world, a lot of spots that could turn into hot spots. Also inflation, if that were to tick up, biggest risk there probably right now is the labor market. Again, if the labor market tightens up considerably and employers start to increase wages, that would be a driver of inflation. In emerging markets, political risk, again, protectionism risk. If everybody starts throwing in tariffs and stopping trade, that would not be a good thing for the global economy. And finally, banking risk, I just talked about that, the fact that if governments go broke, and they can, it happens, governments go broke, that's not a good thing, and it tends to cause a lot of disruption. Consumer sentiment's important because 70% of the economy is just you and I spending money on stuff. The rest of it is business and government spending, the other 30% in other words. But consumers are pretty important because if consumers don't feel good, even if fundamentally there may not be anything wrong with their checking account, if they don't feel good, they're probably not going to spend as much money. Evidence back in 2008, remember when GM and Chrysler went broke almost overnight? Well, that had nothing to do with directly, the financial crisis. They're not banks, right? They're not a financial institution. But when everybody stops buying cars, all of a sudden, that's not a good thing. And you can think about almost any company. If their sales went down to zero, it wouldn't take many months until they would be out of business. Investor sentiment's also important, although not necessarily as much. Sometimes investors tend to do goofy things and go the opposite direction of what they should. But investor sentiment would tend to tell you how much money is likely to be poured into the market or pulled out of the market. And I say investors are goofy because we actually have some good stats on this. The last 20 years or so, you probably would agree with me, it's about 10% or so that the S&P 500 has averaged over that period. But interestingly enough, the average equity mutual fund investor over that same period of time has gotten less than a 4%, just under a 4% rate of return. In other words, less than half of what the market would have performed at. And I can tell you the reason wasn't because people bought bad investments or because their expenses were too high or something like that. Those things may have played in as a small part of it, but the lion's share was market timing, that people tended to pull money out of the market when they shouldn't have, and they poured money into the market when they shouldn't have. And you can see Sir John Templeton's quote here that when things really seemed terrible, again, back like 2008, 2009, that was the best time to buy, even though people were scared. And believe me, there were days where I woke up and I was scared too, right? I was scared to see what financial institution went broke the next day. But it doesn't mean that you react to it, though. That doesn't mean that you make a decision just based off of emotions. On the same token, I was also an advisor back in '99. And back then, people were buying Cisco and Oracle and HP. Unfortunately, a lot of tech companies were overvalued at that point, and people were putting a lot of money into things that were way, way overvalued. So that's where we see opportunity right now, is looking at some areas that aren't overpriced, that aren't as expensive as some of these big tech companies that Luke named before. The Facebook, Apple, Google, Netflix. All these companies are good companies. It's not that they're bad, but they may be very, very expensive to purchase as an investment. Central bank policies, again, this is important. Central banks can cause trouble if they tighten too quickly, for example. They can actually cause an economy to go into a recession. So I would expect, unless we see a huge spike in inflation, and we haven't seen it yet, inflation's still really low, so the Fed is not under any pressure to be aggressively raising interest rates. So I think we're likely to see that trend continue, that rates will slowly go up. And that's exactly what they want to do, because they don't want to raise rates too quickly and cause us to go backwards and threaten the expansion that we're in right now. So ultimately, what it all comes down to is we don't know. I mean, that's the truth, is that nobody really knows what's going to happen, but we can look at some of these data points and at least be able to see the reality that, things aren't all that bad right now. There's a lot of things to feel good about, but there still are some dark clouds out there on the horizon. And that's what we want to be watching, to be aware of at least. And the best way that we can arm ourselves against being those investors that get less than half the return of the market, at least for our stock investments, the way to avoid being that guy is to make sure that we're educated and we're using logic and using good sound experience to be making our investment decisions. So the tried and true principles that we talk about with you in our meetings and our consultations that we've got about diversification, asset allocation, being careful about over-concentrating our investments in one thing, like one company's stock, for example. And the nice thing is that we've got investors that are actually several companies right now that their stocks have done tremendous, have seen huge, huge increases in value, and therefore have become a fairly large percentage of their net worth. So, those are the sorts of things that we try to help people avoid big mistakes by using experience, not only our experience, but experience of experts and the experience with all the investors that we've worked with over the years. So here's us. You can see our team photo here, and we have a great team. That's really our greatest asset, is the fact that we've got a great team. That's why you're here. That's why you're on our webinar. That's why you're a client, is the fact that we've built a relationship, and it's a relationship based on trust. And yeah, we may like each other, but ultimately that relationship, the foundation of it is trust, and the fact that we know that not only do we enjoy the relationship, but we know that there's a reason why you're here, because we've got the experience, we've got the tools to be able to get you where you want to be, and to be able to help you accomplish your goals over time. So with that, I'm going to just open it up for questions. I don't think I see any yet, but Luke and I are sitting here and are happy to answer any questions that you might have. Before some of you drop off, though, again, if you would please do us a favor and share this webinar. When we send it out, we'll send the link out. When we send this out to you, if you would just share it with other coworkers, friends, certainly invite them to these in the future. And also do us a favor and make sure that you're following us on social media. Primarily right now, we tend to be the most active on Facebook. I know some people don't use Facebook, but that's a way that we're communicating a lot of our information about events like these. So waiting for questions to come in. You might not have any, but are there any questions that you've got that you think would be useful for yourself and maybe for some others that are listening? I'll give it a couple seconds here to see if any come in. Again, I know your time is valuable, so I won't prolong it. Thanks, Brian. Brian says nothing here. Thank you for your time. Well, thank you for your time, Brian, and everybody else who's been on here today. Again, I know these days the time is probably the most precious commodity that any of us have. So I definitely appreciate the fact that you've been on here and that you've listened to Luke and I and let us share some insight with you. All right, got one. Debbie asked, what about buying in silver or gold? I'll throw that one to Luke, actually. That's one that we get every once in a while. That'll pop up.
Yeah, so the one thing with silver and gold, and why we're not too fond on investing too much towards those types of particular areas, is they're going to be more commodities based. They don't produce any type of revenue. They don't have any earnings. So really, those are more kind of fair type investments. And there's a lot of other things that we can do alternatively to kind of take care of that portion of your portfolio. So we don't spend too much time in research or allocations in our clients' accounts, just because those areas do happen to be a lot more volatile than you would expect. Gold's done well recently, but it's jumped up pretty substantially over the last year and a half. But looking 2 years prior to that, it really got hammered. So it was almost the equivalent of what oil was looking like as far as the swings that you could see with those types of commodities.
Yeah, I think I'll just echo that. I think gold, over my career, I started doing this in '99. I think gold or commodities in general as a long-term investment are not a great place to put money. There are certain commodities that can do well for certain periods of time, but it requires good timing. And like we talked about before, nobody really knows. So you could end up with some huge swings in owning an investment like that.
Yeah, and Debbie, just I know you watch a lot of Rockies baseball. It's the equivalent of someone going up to bat and just swinging for the fences every single time, even though, well, all you probably need to do is get on base, basically, and kind of try to be in the game and play some proper baseball, basically, and you have a good shot at winning the game. And so that's why we avoid some of those other things that are more home run swings, where you start doing those types of things, you stop following a diligent process, and then your form gets off and stuff of that nature. So hopefully you like that baseball analogy.
Yeah, there you go, Rockies. That's right. Yeah, they're doing well this year. Yeah. One thing, as we're waiting, there might be some more questions that'll come in too, so keep asking anybody who's out there. But the other thing too is that we've started using some software that helps us analyze risk in our client portfolios. And the reason why we do that is not because we don't know how much risk things have. We've been doing this a long time, but it's also to illustrate it to you and to help you understand for any given investment that you're considering buying, or maybe that your friend told you about, that you understand how much risk is associated with that investment. Because a lot of times people end up buying something just because it sounds good, or because their neighbor bought it, or because maybe it's run up in price over the last couple of years. So the interesting thing is that you look at something like silver or gold on a scale of 1 to 100, 1 being maybe a CD and 100 being putting it all in one stock. You'd be looking way up into the 90s with any kind of a commodity typically, and especially silver and gold. So again, it doesn't mean that you can't make money for a period of time. Got another one. This one actually comes up. Some people will laugh, but it comes up fairly often. What about medical marijuana? So that one I'm not an expert in, first of all, as an investment either. That one's pretty complicated because as an investment, some people may not know this yet, but marijuana technically is still federally illegal. So that means certainly as an investment that we could offer you through our service, we wouldn't be able to do that because we're federally regulated. But yeah, there is a lot of unanswered questions out there with how those companies do business, what their future is. Again, based on the fact that they're federally not legal, at least yet. What their liability might be if you had some kind of a federal crackdown. Their banking is tough because they can't deposit money in a normal bank because banks primarily are federally regulated. So it's a really interesting business. Certainly there's been a lot of money made, I know that, and generated a lot of tax revenue in Colorado at least, and some other states that have started that. But yeah, as an investment, I think it's pretty speculative. Anything that's new typically is going to be pretty speculative. Remember the dot-coms back in the late 90s? I don't know, obviously very different business, but if you remember the dot-coms, there's only a handful of those companies that even survived. So for people who poured a lot of money into those stocks, even though obviously the internet's done great, right? We all use it, we're using it right now, but that doesn't mean that all the companies that are in that will end up turning a profit or may not turn a profit in a way that would be able to be recognized by you as the investor. What other questions? What else is out there? Well, I will wrap it up unless I see one coming here at the very end. Again, thanks for the time today. I certainly appreciate the fact that you all tuned in. We like to do this. Luke and I enjoy doing this, and whether it's live at a physical location or we do it online, we really enjoy the educational component of our jobs. And ultimately, we just want to get you to where you want to be and get you there safely. So ultimately, we want to be here as your resource, your advocate. Certainly, tell other people about us. That's primarily how we get new clients and people that attend webinars and seminars and things like that. So. Yeah, Bill, thank you too. Thank you. Suffice to say, if we didn't have our clients, if we didn't have your support, we would not be a business. We wouldn't have any profits. We wouldn't have any earnings. So thanks for taking the time to visit with us today.
Yeah, and one thing I just want to add on is, with all the different possibilities that could come up down the line, in particular the tax reform, healthcare reform, and things of that nature. As things become more definitive, that's going to be a focus areas of ours to come out either with a quick webinar or a quick Facebook Live or some white papers, things of that nature. We're definitely keeping our eye on those things. So far, it's been more posture than anything that's truly going to be coming out in the pending future. So that's why we haven't been providing too many details on that, is because it's all very, very hypothetical at this point, but we're going to keep an eye on those things, and obviously if they provide an opportunity, that we're not only going to communicate it pretty wide, but we're also going to make sure we drill down in those individual meetings of yours to see how they're relevant for you as an individual.
Great. Well, thanks for the time, everybody, and we look forward to seeing you soon in the office at an event or back here online.